What's up, YouTube? Herman Williams back with you again. In my last lesson, I talked to you in some general terms about how to determine how much money you need to retire comfortably. I gave you some simple formulas to help you set some short-term and long-term goals to help you build your retirement nest egg. Well, today I want to build on that and give you some tips and tools that will hopefully help you understand how to create a retirement portfolio strategy that will align with your goals and milestones. Once you have that nest egg built, you should know how to make it last. You should also know that your investment strategy should change over time. Stay right where you are. We're going to talk about all of that and more. I'll be right back. Whenever it is that you finally reach retirement, you will have two rules that you hope your retirement portfolio will be able to follow. Rule number one, don't run out of money. That's one of the biggest fears retirees have is, will I run out of money? Nobody wants to retire and then have to go back to work. Now, you may choose to do some part-time work in retirement, but no one wants to have to do it just to make ends meet. Rule number two that you hope your retirement portfolio will be able to follow is never forget rule number one. So what should be your strategy when structuring your retirement portfolio? What will put the odds in your favor to be able to adhere to rules 1 and 2? Well, there's basically two things to be concerned about regardless of what stage of nest egg building you're in. One is the need for safety and capital preservation. In other words, you don't want to take on too much risk and you don't want the value of the money you have invested to decrease. Now, that doesn't mean that there won't be fluctuations, but over time, you want to preserve as much of your investment and its growth as possible. The second concern that you should have is for the need to grow your investments at a rate that at least hedges against inflation, both during your working years and over the life of your retirement. If you invest solely for safety, meaning you're heavily invested in things like treasury bonds, there is a high likelihood that you will run out of money at some point. If you invest solely in equity or stocks, you could have higher expected returns, but along with that expectations comes much higher volatility and risk. During a down market, that volatility could decrease the value of your portfolio to a point where you don't have time to recover. You need balance. Total return rather than income is the word for today when it comes to retirement-oriented portfolios. With the balanced portfolio, the goal would be to design a portfolio that balances the requirements of liberal income, meaning that you can make withdrawals to support your lifestyle, with sufficient liquidity to be able to withstand down markets. Now, one way to design this balanced portfolio is to start by dividing it into two parts with specific goals for each part. Part one would be our equity portion. Our goal here is to gain the widest possible diversification that reduces the volatility of the equity portion of our portfolio to its lowest practical limit, and while still providing the long-term growth necessary to hedge against inflation and meet the total return necessary to fund withdrawals. Now, don't think you need to be able to analyze and pick a bunch of individual stocks to gain this kind of diversification. You can easily accomplish this with a series of mutual funds and ETFs or exchange-traded funds. Just remember, you want the weighted average return for this portion of your portfolio to meet your retirement objectives. Now, what that weighted average return needs to be is very specific to each individual. If you put together a large nest egg and your retirement expenses are relatively low, you may only need a 4% return in this area. If you were late starting your retirement planning and your nest egg is not as large, you may need to structure this portion of your retirement portfolio to give you an expected return of 7 to 8%. Just remember, with higher expected returns come higher expected risk. Part two of your balanced retirement portfolio is the fixed income portion. The role of the fixed income portion is to provide a store of value to also support distributions, but also to mitigate the total portfolio's volatility. This portion of your portfolio provides stability and is designed to be near money market volatility rather than attempt to stretch for higher yield by increasing the duration or buying assets with lower credit quality. Here we're mainly talking about high quality government and investment grade corporate bonds. Again, this can be accomplished with a series of mutual funds and ETFs. Income production is not the primary goal, but also remember that this portion also needs to meet our weighted average expected return. On average, we're expecting 2 to 4% return from this portion of our retirement portfolio. Both portions of the portfolio contribute to the end goal of generating a liberal, sustainable withdrawal rate over long periods of time. Notice that we're not specifically investing for income, but rather we're investing for total return. Now, I should probably point out that this balanced portfolio strategy is what you should have going into retirement to ensure that you can support your lifestyle and not run out of money. During your working years, the weight of these portions will shift over time. Your portfolio mix should migrate from growth or aggressive growth and asset appreciation in your younger years to a more balanced portfolio over time. This is also what target date mutual funds do. They change your mix and reduce your exposure to risk as you get closer to retirement. A word of caution about target date funds though, depending on the amount of your contributions and how long you have until retirement, a target date fund may not provide the return you need over time, and they may make adjustments to your portfolio mix at the wrong time for you. So how can an investor generate a stream of withdrawals to support their lifestyle needs from a total return portfolio? Well, you start by setting a sustainable withdrawal rate for yourself. Now, most experts believe that an annual withdrawal rate of 4% is sustainable and allows a portfolio to grow over time. But remember, that assumes that your weighted average return on your balanced portfolio is sufficient to support that. Next, set your asset allocation to 40% short-term, high-quality bonds and 60% to a diversified global equity portfolio of perhaps 10 to 12 asset classes. How much of that 60% needs to go to which asset class is specific to you, your risk tolerance, and your expected rate of return. Again, all of this can be accomplished using mutual funds and ETFs. And third, have your distributions withdrawn dynamically depending on market conditions. Meaning if the equity portion of your portfolio is outperforming expectations, take a higher percentage of your withdrawal from this area. Depending on the size of your nest egg and the amount of your withdrawals, the 40% allocation to bonds could support distributions for 10 years in a down market before any volatile assets like your equities would need to be liquidated. I'll leave a link in the description below to a calculator that can help you see how long your money will last with different rates of return and different withdrawal rates. Be smart about where you take your money from during retirement and try to have a flexible retirement budget, meaning when markets are down, you should have the flexibility to spend less. When markets are up, you can afford to spend more. This mindset will go a long way toward preserving your nest egg for as long as possible. Rebalancing should also be a part of your retirement portfolio strategy. Rebalancing involves looking at the value of assets in your portfolio, your stocks, bonds, etc., and selling those that have exceeded the percentage allocated to them when you first structured your portfolio. You can also use this rebalancing strategy while you're building your nest egg. Rebalancing within equity classes will incrementally enhance performance over the long term by enforcing a discipline of selling high and buying low as performance among asset classes varies. When you are living in a low interest rate world, as we are right now, It's easy for investors to become obsessed with yield. They think they will boost their portfolio's performance, but even for retirement-oriented portfolios, a total return investment strategy will yield higher returns with lower risk than an invest for income approach. This means you could have higher distribution potential and increased terminal values or higher capital retention while reducing the probability of your portfolio running out of funds. As always, this is not a one-size-fits-all strategy. Depending on your nest egg size and how long you need your money to last, you may need a slightly more aggressive mix, such as 35% bonds and 65% equity. Put this information together with what we discussed in the last lesson, and you should be able to set a goal for how much you should have going into retirement and feel confident that you can support your lifestyle in retirement and not run out of money. Continue to educate yourself and take a more hands-on approach to managing your money at all stages of your life, and stay safe out there and continue to adjust and change and modify your financial behaviors. Remember what I always say, change your behaviors and you can change your life. So until next time, behave well.